Hello, good afternoon, good morning, or good night, wherever you are watching this. This is the Be the CEO of Your Life live show. Hi, I'm Yvonne of Amaze Yourself Coaching, and I help ambitious entrepreneurs to create more time within their business so they can enjoy their life more. And for me, it is pivotal that entrepreneurs work less but get more results. And today I'm very excited because I have a very special guest with me, David Safir. David, welcome.
Thanks, Yvonne. It's so wonderful to be here. You know, I love chatting with you, and to do so in this type of format is that much more fun.
It is, isn't it? Yeah, I really appreciate it. So for those who don't know you, can you please give a quick introduction of yourself, who you are and what you do?
Yeah, I'd be glad to. So, Yvonne, what I do is I am a cash flow advisory specialist. I advise companies on how to optimize their cash flow. I got started with large corporations, and when I left large corporate America, I realized that many smaller companies, it's the number one issue is how to manage cash flow. And I try to bring them from cash flow crisis to cash flow management to really optimizing their cash flow for maximum profitability. That's what I do, and I love it.
Okay, and you're great at it, right? You know, everybody who follows you on LinkedIn sees all the content that you share, and I'm pretty sure that many people have gained so much knowledge through you.
Well, one of the things I try to do, I'm not a finance person from background. It's not my background. I'm a general business person. And I realized one of the huge disconnects within large corporations, but also between quote unquote experts, is that people speak different business languages. And so one of my fundamental goals is to make finances, accounting, bookkeeping, everything having to revolve around cash flow understandable in very plain language. And I think maybe that's why some people are attracted to what I'm teaching, is because they can understand it better because I'm not using a lot of jargon.
Yeah, I definitely think that that's a great benefit. And what I also like is that your approach is different to the more traditional accounting way. And you said it so beautifully. You said, stop driving your business by looking in the rear view mirror. Can you elaborate on that? What do you mean by it?
I'd love to. I really get excited about this particular aspect of what's happening in the business world. I talk to small business owner after small business owner. For me, a small business owner is somewhere that I work with, but up to about $20 million, $30 million. And then all of a sudden you end up with an accounting department and there's a lot more support. But I talk to business owners of these smaller businesses and I say, what is your accountant doing for you? And the bottom line is they are providing backward-looking information. So if my client, company president, wants to know what they did last week, they can look.
Yeah.
But they're looking in a rearview mirror because they're trying to go forward with the company. So there's these reports that are pointing in the past, but they really don't help you move forward, because trying to drive forward, you should be looking at forward-looking statements.
Right, right.
Do you mind if I explain why this is a problem?
No, I would love to. And also, when you explain, talk to me a bit, because I don't want to give the impression that you are against accountant. It's just an add-on and a different view, isn't it?
Absolutely. People need financial reporting for many reasons, one of which is to pay taxes, to get bank loans, and it is a good measuring stick about how well you're doing on certain measurements. I am not in any way, shape, or form saying that is not an important function. But let me tell you about a discussion I had with a good friend of mine. His name is Dan. He was invited to be on the International Accounting Standards Board. You only get that from invitations. And he was in his 40s. He's really made a lot of progress. And we've talked about this. And he says, absolutely, the International Accounting Standards Boards recognizes that this is a problem for small companies. The fact that it's backward looking, but also accrual accounting, which theoretically, and this is accounting theory, not fact, it's theory, but it distorts the books to the point where a client, I'll never forget this, they said, David, my accountant told me I made $250,000 next year. But he was literally choking up going, where's my money? Yeah. Where is my cash?
Yeah.
And it wasn't in his bank account. He was at risk of going bankrupt in 2 or 3 weeks. Yeah. So he was looking at backwards looking. And why does the accountant present that? Everything about the accounting profession is based upon his recording history. Yeah. That's what the accountants are taught.
Yeah. Yeah.
Bookkeepers are taught. Yeah. CPAs. The entire CPA, and that would be a chartered accountant in many other areas of the world, CPA in the United States. It is all about history, audits, taxation but it's taxation on historic. So let me tell you about part 2 of my discussion with Dan.
Yeah.
So my first discussion was about 2 years ago. I talked to him about a month or 2 ago, just to do an update. He said, David, I've taken a break. And I'm now the CEO, temporary CEO of a company that does everything online.
Yeah.
They still do the historic reporting because they have bank lines of credit and they have to pay their taxes. But every single day they sit down and look at what they did the previous day to make decisions of how much money they were spending on online advertising that day and where. So they're doing accounting in real time.
Right.
To make real-time decisions. And he fully supports this whole objective of understanding where your company is going, not constantly looking backwards. Now, I know you're looking backwards to yesterday, but the point is you're making decisions to go forward today.
Yeah. But isn't it also true that you need your history to understand where you're going, but you just need also to prognose where you're going, and I think there's a difficulty in looking at these numbers, understanding them, and then also understanding that it doesn't. So one of the things that I find beautiful is, okay, if you look at your numbers and you see your profits, it's not necessarily the cash in the bank, and it because it's all counting, right? It's all the accountants have calculated. But it's long gone, or it can also sometimes just surprise you because there's no more money, and then you get this tax assessment, and you're like, where does that come from?
Right.
So isn't it also that it's great to have those details from the past, and like you said, you need them, but also the part that is actually missing and that you are offering is more forward-looking, saying this is where you're gonna go. So based on that prognosis, this is what we advise you to do. Invest, not invest, take a loan, things like that. Is that my understanding correctly, that it's really helping you to understand better where you can go?
It is. So there's the large picture and then there's the small details. The large picture is exactly that. You're trying to paint what your road looks like down the road based upon a little bit of historic, but you should also know a lot about what your business is doing. For example, you can see historically seasonal trends, up and down, up and down. So you should be able to diagnose when you're going to hit low points. So you pull back on expenses, or you use that to create new inventory for your high point. Whatever your business is, you will see seasonality. That's big picture type of stuff. You plan for both the revenue and the expenses that coincide with that type of revenue. This is especially critical for companies that are growing quickly, because if you're not planning for the additional expense, then you can be in real trouble. And you see more companies. As a matter of fact, every single company I'm working with right now, and I don't work with very many companies. I work with 2 or 3, sometimes 4 at a time, and I'm working with 4. They're all growing faster than they can keep up with. That's why they contacted me.
Right. And if you say faster than they can keep up with, is it just because I think it's every entrepreneurial dream, right? To grow. So
yes.
What's the downside then from growing so fast that they can't keep up? Is it because they don't know where the money is, or they overspend? Talk to me about that.
All right. So the truth of the matter is cash flow shortages are usually a symptom of a larger problem.
Right.
And for most of the companies I work with, the root cause is a personnel problem.
Okay.
And the personnel not keeping up with the skills and abilities in some way, shape, or form that the company requires. Right. We're not being allowed to, that they have the skills and abilities, but the way the company is run, they're not allowed to provide that. But let's step away from that kind of a root cause and take a look at the cash flow. The number one reason I see that people get in trouble when they're growing quickly, they do not understand the relationship between a sale, there's 3 things, the sale, and the cash going into the bank account, right, and when the expenses will hit for the expense of making the sale.
Right.
So when you make a sale, is it the date that the client says, I want to buy this?
Yeah.
The salesperson would say yes, but
that's his commission.
That's not what the legal team would say. The legal team, whether it's an external lawyer, they would say it's the day you get a signed purchase order or a contract.
Right.
But is that what the accounting department would say? Well, no. Accounting department would say it depends. If it's a large contract, you only make the sale over time. You're making the sale. This is the accrual accounting that you have to do, or even if it's cash accounting and you deliver a $1 million contract, $100,000 a month, that's over 10 months. You're making a $100,000 sale over 10 months.
Yeah. Yeah.
Okay.
Yeah.
But what does that have to do with anything? The only thing it has to do with anything is when does the money come into the bank? And that could vary dramatically. You could require deposits. So therefore the money could come in early, which is fantastic if you don't go spending it on a new sports car when you need to spend it on inventory to fulfill, which happens. People go buy cars, houses. But the cash, when is the cash coming in that will support the expenses and making sure they match? And all too often in a service business, to fulfill contracts, you have to hire people that are paid a week, 2 weeks. If you have to train them a month, 2 months, 3 months of paying out before they can actually produce for you.
Yeah.
So you need that capital. And it's the same thing if it's a production type business where you have any kind of inventory. You have to be careful because oftentimes you need the inventory before you get paid, and you have to pay for that inventory before you get paid for the delivery of the product. And that's where you end up with these gaps.
Yeah, I hear you. So are you then saying that if somebody sells a big contract worth $1 million, right, that at that point of time, and of course, well, maybe you have true stories, but so they think, oh, now I made $1 million, and then they go buy the sports car because they know somewhere they can afford it. Whereas in reality, they can't afford it because the money isn't coming in at once. It is actually coming in per month. And even though that might cover part of the sports car, depending on what car you buy, but even then still, they also have the expenses. And sometimes the expenses go ahead of the actual sale coming in, because I hope they have trained people before they have sold it so they can actually deliver on time. And they didn't incorporate that in their thinking. because then you are in true trouble.
It is. And so that's part of what I do, is help them understand this. Say, great, you want a sports car at the end? Let's set money aside every single time you get paid by this client. Let's take 5% or 10%, whatever the number is, but don't spend it. And here's why. When is the last time you had a big project that was like a large percentage of your revenue go exactly as planned?
Right, true.
Unexpected costs. People are trying to live hand to mouth oftentimes, and they're used to it because they're in such desperate trouble that we really need to take a pause and say, how much cash reserves do you need? Or can you get a credit line that you do not touch and use that as reserve in the case of an emergency?
I hear you. I hear you. Yeah.
So that's part of the work I do right now. Right now, I'm working with a client. We're trying to replace bad debt with better debt. And what's bad debt? Super high interest rate, credit cards, loans that just have ridiculous terms with basically a bank line that's going to pay off those debts, and then they'll have regular payments on a lower interest rate. That's a key thing, is to have good debt.
Right.
If you're going to use that at all.
So you take everything into account when you have the conversation with them.
Absolutely. It's not just managing, it's optimizing. Even if they could survive just fine with this high debt, why would you want to? If you can get a $40,000 a month payment down to $20,000.
Sure. Yeah.
And you're paying less interest, and well, David, we want to pay it off faster. That's great. So make a $40,000 payment, and so you're adding additional capital, and you can pay it off faster.
I hear you.
But you relieve the pressure.
Yeah. So one thing that, and maybe we already touched upon it, but the terminology, right? The terminology can be confusing. And one of the things that I read about a lot, and that I think we already touched upon, but I just want to make sure that I understand it. Some people talk about revenue and some people talk about cash, right? Now, if I listen to your story just now well enough, the example with the 1 million and the 100,000 per month, in your example, am I then right to assume that the revenue, which is the overall money coming in, is 1 million, but the cash that month is 100,000. Is that how I should see it, or am I now confusing it?
Okay, so that's a really good question. To me, revenue is theoretical. And why? Right. Because accountants say that the revenue is made the minute you invoice that customer.
Yes.
So it's January 1st or January 31st. Either way, that's revenue for the month of January.
Yeah. Even when you receive it yet, right?
When is the cash? Yeah.
Okay, right.
All right. And so, and the important part is I deal with reality as much as possible, and you can get realistic forecasts 4 to 6 weeks out. I'll give you an example. I'm working with a client, and they say, "Oh yeah, we just invoiced them. They're going to pay on the 15th, which is like in 2 weeks." And I said, "Okay, are they really going to pay on the 15th? Is that realistic?" They thought for just a couple of seconds, like, "Nah, they always pay late." "Okay, how late do they pay?" "A week or two." "Okay, so should we schedule a week or 2 weeks out?" 2 weeks out. That's what you really should be thinking about constantly. What's reality, not theory, and not looking. But in this case, looking backwards actually helps, because you're saying, what are the patterns that we've seen in the past that we can apply to the future?
Yeah, I hear you. Yeah. So I recall when I worked in a corporate, one of the projects I was involved in for a certain amount of time it was called bigger firms help smaller firms, because one of the things that small enterprises really struggle with is the terms of payment. Because a lot of these larger corporations, they have like 90-day payment terms, right? But if you are a smaller firm, 14 days or 90 days makes a difference of life and death. So how do you deal with that? And what's your advice on payment terms in that way?
You know, I actually had a client who dealt with this. It's the only client ever said, you really need to shut your doors.
Oh, wow.
Because, so let me just talk about large firms coming from a large corporation.
Yeah.
I had to do it, and somebody who comes out of a large corporation and wants to advise small businesses has to change their mindset to, we're just going to treat them like a large company. This particular client, I don't do coaching, I don't do general business advisory, but he asked me to do that. So I said, that's fine. We set up a cash flow spreadsheet, but he never let me look at the books per se, that I really did a deep dive. A year later, he was still in trouble. I did a deep dive, and what I discovered is that the accountant who came out of a Fortune 25 company, a huge company, they were a controller, was misapplying certain accounting principles to a small business and was doing some double counting of some receivables.
Oh.
And I realized that it was never going to get fixed because he had to pay his suppliers in 30 days. But the receivable best case scenario was he was getting paid in 90 days.
Yeah. Yeah.
So he had a 60-day gap. Now, if he knew that up front, he might have been able to make arrangements with a bank and say, listen, I need a growing line of capital. But I've got such a well-run company, I'm going to show you every single quarter, every single half a year, and you're just going to keep giving me more and more capital because I'm profitable.
Yeah.
Instead, he made quick decision, rash decisions and got into bad debt of credit cards and merchant account loans. And I said, you're never going to dig yourself out of this. You no longer have the capital or the credit to be able to fix this.
Yeah.
And he ended up winding down, and I felt guilty for years, but I happened to talk to him about a month ago, and I told him I felt guilty, and he said, why? Because using the cash flow system that we had put in place, he was able to keep his doors open and know he was going to pay his payroll and everything else. And he was like, David, I got to all sorts of things that I wanted to because we were able to manage through it, but it was never going to be a real success.
Well, I think this is a good story to end with, because I feel like we can talk for hours.
I could at least. I love this topic.
It's fascinating. So, I can talk about this. But is there anything you want to close with, or something I haven't asked, or something you really want to share with the audience before we close down?
Yeah, I guess I do. What I found is that there's a lack of training in the marketplace. I picked this up piece by piece and didn't realize that I sort of have a unique knowledge set. But once I realized it, I developed a course. It's available right now for business owners. It's designed to get business owners up and running and understand this better. And I'm developing a course. There's accounting professionals, bookkeepers that want to learn how to do this so they can provide it to their clients. I'm developing a course for them right now. So if anyone wants to stay in touch, contact me on LinkedIn or go to my website. I've got a free download, davidsafir.com. I've yet to send out an email, so you're not going to get spammed. But let me know. And I'd love to stay in touch with anybody who wants to learn more. It's one of my driving forces is to teach the world how to do this. Yeah.
And you share almost daily on LinkedIn very valuable insights, so that, what we discussed now and more you can find there. But it's even better when people go to your website, davidsafir.com. I'll make sure to post a link in the comments. And there are also free downloads, and they can look at your training, which I know people are raving about, to actually learn and understand this the way you're explaining to us now.
Well, I appreciate you doing that. Yvonne, it's always such a pleasure to talk to you.
Same here, David. Thank you so much. And with that, everybody who's watching, thank you for watching. If you're watching this in a replay, let us know, #replay. Any questions, David will sure answer them for you. If I see them and David doesn't, I will make sure to tell him. And with that, I would look forward to wishing you a very, no, today's Thursday, I was going to say weekend. I'm looking forward to seeing you tomorrow on Friday, same time, same place. Bye for now.
Bye-bye.